Hello and welcome back to another video lecture dealing with Chapter 12, Differential Analysis, the Key to Decision Making. So in our previous video, we talked about the constrained resource and we calculated really the best way to utilize that constrained resource, right? We had two products that we made. Each product had different contribution margin, and what we did was we said, okay, we have this constrained resource, let's figure out which one of these products we should satisfy demand for, right? Which one gives us more bang for our buck, we said. So in this video, we're gonna kind of continue on with that idea of a constrained resource, and we're also going to jump into our final decision, joint production costs and selling or process further decisions. So when we have a constrained resource, as a manager, we may want to make the decision to actually increase the capacity of the bottleneck. Okay, so if you remember, we gave the example of the emergency room, and we used the triage nurse, saying, you know, we only had one triage nurse, so that's where the bottleneck came in. Well, we as managers could say, hey, you know what? Whenever things get busy, whenever we anticipate busy times, specifically in a hospital, maybe we put another triage nurse up front, or maybe we put two more. We have two more nurses that can screen the patients, take their vitals, ask them what's wrong and whatnot. So what happens is when a manager decides to increase the capacity of that bottleneck, basically what we say is they are relaxing the constraint, or they are elevating the constraint. Okay, so working on with the example that we had, how much would Ensign be willing to pay for an additional minute of machine A1 time? So what we could do then is we can relax the constraint, right? We can increase the capacity of that bottleneck. That's great, but in managerial accounting, okay, that's going to help our process out, but how much are we willing to pay? What's the dollar amount for that? So in order to figure that out, we need to think about what is the contribution margin. Okay, so the additional machine time that Ensign would use to make more units of product one has to be relative to the, or comparable rather, to the contribution margin per minute. So we already saw in that prime example, let me go back here just to look. We already saw that, hey, product one has a contribution margin of $24. So what we're saying is we're willing to pay up to $24 per minute. Okay, that's equal to the contribution margin per minute of machine time that we can earn if we're producing more units of product one. Okay, so the idea is to figure out, we have a constrained resource, we want to increase that resource, maybe we buy another machine, right? We get an additional machine A1, right? Well, how much are we willing to pay for that machine? Well, we're willing to pay $24 per unit, right? Or a contribution margin, we're willing to pay for a contribution margin of $24 per minute. Okay, so let's just kind of take a quick look here. We have Colonial Heritage. They reproduce colonial furniture from selected hardwood. So they make chairs and they make tables, right? So what we have here, We have the selling price per unit for chairs and tables. We have the variable cost per unit for chairs and tables. We have the board feet per unit, and we have the monthly demand. Okay, so the company suppliers of hardwood will only be able to supply 2,000 board feet this month. Is there enough wood to satisfy the demand? Well, let's think about that. We make 600 chairs and we make 100 tables. For our chairs, we use 2 board feet. So that's basically $1,200, or I'm sorry, 1,200 board feet just for chairs. Okay, well, let's look at tables, right? Well, we use 1,000 board feet for tables. So if we add those two up, the 1,200 and the 2,000, we do not have enough supply to fulfill all the demand of all the products, right? So no, we don't. And here's the calculation, right? Board feet per unit, 2 times the 600, plus tables, board feet per unit, 10 times the demand, 100 units. That's the 2,200. It's greater than the 2,000 board feet that we get supplied to us. Okay, so we're only able to get 2,000 board feet of supply. Okay, we have to figure out what would be the maximum profit. How many should we make? And remember our formula that we use, right? First thing we got to do is figure out what is the contribution margin for chairs and for, bear with me here. I just want to pull up a drawing tool here. Okay, so what's the CM for chairs? Well, selling $80 minus the variable cost of $30, that leaves us with $50 contribution margin for the chairs. Table, what's the contribution margin? Well, selling price per unit is 4,000. Variable, or 400, excuse me. The variable selling price per unit is 200. So that means we have a contribution margin of $200. Okay. The second thing we need to do is figure out how much material goes into one of these units of chairs and tables. Okay, so they give us that information right here. They say, hey, board feet. So we want to figure out what is the contribution margin that we get by using a foot of board, right? So we know that the 2 is the amount of board feet that go into a chair. Tables 10. Okay, so we see that for the chairs, the contribution margin per excuse me, good Lord, if I could talk, per board feet is $25. And I see that the contribution margin per board feet for tables is $20. So right off the bat, I'm getting more bang for my buck. So guess what I should do? I should make all of my tables, or excuse me, all of my chairs. Okay? So if I'm going to make 600 chairs, the board feet required for that, I already figured out, is 1,200, right? 1,200 board feet. And if you're still unsure where I got that from, that's the 600 times the 2. Okay? So how many board feet do I have remaining? Well, remember, the original supply is 2,000. So 2,000 minus 1,200 gives me 800 board feet left. How many board feet per table? Well, it's 10, right? 10 board feet per table. I only have enough material left to make 80 tables. So B should be our answer. And there it is right there, what we just worked through. Remember, first calculate the contribution margin, then calculate the amount of the constrained, or determine what the constrained resource is per product, and you have to compute the contribution margin per that constrained resource. You figure out which one gives you the most bang for your buck, meaning which product has the highest contribution margin per constrained resource. Right off the bat, you're going to produce, or you're going to fulfill the demand for that product. Anything left over, you're going to start, you're going to produce the other product. Okay? So not too bad. Let's see here. As before, Colonial Heritage supplier of hardwood will only be able to supply 2,000 board feet this month. Assume the company allows the plan we have proposed. Up to how much could Colonial Heritage be willing to pay above the usual price to obtain more hardwood? Well, let's think about that. We already mentioned we got to figure out what is the contribution margin, right? So we already know that chairs, we're good. We're producing all 600 chairs. We know that, right? It's the tables we're only going to produce 80 of. So how much would we be willing to pay above the usual price to obtain more hardwood? Well, it's the contribution margin of that product, $20. Okay? Why? Because if we pay $20 above the original price, that means that our contribution margin is going to go to zero, right? On a per unit basis, okay? We'll have enough, and if you think back to CVP analysis, we'll just be breaking even on those tables, okay? So let's jump into our final decision that we have to make. Should we sell as is, or should we process further and sell? Okay, so what we're going to look at is joint products, right? Those joint products, should we sell them at the split off point, or should we process them further? Okay, so before we get into this, we got to kind of identify some concepts, right? What is joint products, right? Joint products are anything that are produced from a single raw material input. Okay? Think about it this way. I live out in Greensburg, and we got a lot of, actually I'm more in Newstand, so I'm not completely in Greensburg. Why'd I tell you that? The point is, we got a lot of farms around here, right? Or at least where I'm at, I got a lot of farms. And there's dairy farmers around here. So think about it. What can you make out of cow's milk? You can make anything, right? Butter, ice cream, cottage cheese, right? Cream cheese. You can have just plain old milk, whole milk, 2% milk, right? So the point is that milk from the cow is a raw material. That's the input, and from that input we can make a number of different things. Okay, oil is another example of some, or crude oil is another example of, we can process further and get other products from the crude oil. So when we're thinking about this, the joint product costs, right? We have a product that basically comes, or two products rather, that come from a single raw material. Okay, so the point in the manufacturing process where the joint products can be recognized as being two separate products, that's called the split off point. Okay, um, so what we need to do is we need to focus in on that split off point, and we need to make a decision. Do we sell it as it is, or do we process it further and then sell it? Okay, so not too complicated, right? So the example here is petroleum, right? Um, we can get a lot of things from petroleum. Okay, we have joint input, and then there's some common costs that we incur, um, to get that petroleum. Once it hits a certain point, it can be recognized as different products, right? It can become oil, maybe it becomes gasoline, maybe it becomes chemicals, right? Or maybe it can become one of the other products that come from, um, crude oil, right? We can get jet fuel, we can get heating oil, maybe we get a lubricant. So that's where we're at here. We're right here at this split off point, and we're trying to figure out, do we sell it as it is, or do we process further and make oil, gasoline, or chemicals, or whatever? Okay, so one very important concept here is that the joint costs that are incurred up to the split off point, these are always included and they always carry forward. Okay, so from the split off point, we could make oil. And then in order for us to make oil, there's additional processing that has to go on. Okay, the same thing with gasoline, right? Gasoline, we don't have to process further from the crude oil to the gasoline. There's no further processing. We can just go ahead and make the cell, right? Same thing with the chemicals, right? Up to this point, we incurred all these costs, and we could get one of three products. So let's say we go the chemicals route. We have the product. We have to um, do some more processing, right, in order to take this gunk, for lack of a better term, that we have, and actually turn it into the final product, or the hit the final cell. Okay, so there's additional product costs that go into turning this gunk into the actual chemicals that we want. Sorry. So basically that's what we're going to do. We're going to figure out what costs we need to identify, and then we're going to talk about what benefits do we use to determine, should we sell it as is or should we process it further. Now, in order to do that, we have to recognize that joint costs, those are always irrelevant costs. Okay, regardless of what we do, whether we sell as is or we process further, right? All the joint costs that are included in the product up to the split off point, those are irrelevant. Okay, the only thing we have to worry about is any differential costs or incremental costs that are incurred after the split off point. So if we take the split off point, let me go back up here, maybe. There we go. So all these costs, these are irrelevant. Okay, any forward costs, these are good. These are what we need to consider, and these are all going to be incremental, either costs or incremental revenue. Okay, so let's look at an example here. Sawmill Incorporated cut logs from which unfinished lumber and sawdust are immediate joint products. Unfinished lumber is sold as is, or it could be processed further into finished lumber. Okay, sawdust is sold as is to apparently sawdust is good for gardening. Okay, or they can take the sawdust, they can process further, and turn it into Presto logs. I'm assuming a Presto log is something you put in a fireplace. Okay. So what do we look at? Well, first thing we got to do is we got to get some information about the logs, and we got to get some information about the split off point, right? Up to the split off point, what are our costs? What are our revenue? Well, it says lumber. At the split off point, this unfinished lumber, we can either sell it and we get, looks like we get a $140 or $140 per log or per board. And the sawdust, if we sell it as is, once we hit the split off point, we get 40 bucks. Okay. So right here's that split off point. Now we need to figure out and calculate all this additional information. Okay. So the sales value after further processing. So we're going to finish these boards. Okay. We're going to turn this sawdust into a Presto log. We can get $270 per board, and we can get $50 for the sawdust. Okay. But in order to do that, we are going to incur more costs, right? We also need to factor in the allocated joint product costs that we have from turning it into raw material into the split off point, right? Split off. Okay. So we allocate the joint cost, 176 bucks for lumber, 24 for sawdust. And then the cost for further processing, right? We got to take that rough board and turn it into a finished board. Well, we're going to have to incur some more costs to do that. Maybe some more labor, maybe some more overhead, maybe some more indirect material costs. Maybe we varnish it or treat it with something. I don't know. That costs $50. Same thing with the sawdust. If we want to turn it into a Presto log, maybe we have to compact it and maybe, wrap it in paper or something, make it look like a log. So again, there's further processing costs. Okay, so where are we at now? Well, we have the sales value of further processing. Okay, we have the sales, we have the additional or the sales value at the split off point. So we see here we're comparing the difference, the incremental revenue, right? I could sell as is for 140 bucks, or I can put more into it and get $270 per board in sales revenue. I have incremental revenue just from the lumber of $130. We do the same thing with the sawdust, right? I could sell as is for 40, or I can process further and sell it for $50. So we have incremental revenue of $10. Guess what? We do the same exact thing with the expenses. Okay. For the lumber, if we process further, we're going to incur costs of $50. If we process further the sawdust, we're going to incur $20. Right? Those are those incremental costs that we're going to incur. So what's the financial advantage or disadvantage of processing further? Well, if we process this lumber further, we're going to get $80 more. The sawdust, if we process further into those Presto logs, we're actually losing $10. Okay? So really what we want to do here then is we want to process further the lumber, and the sawdust, we're going to sell it at that split off point. Okay? And guess what? That's the end of chapter 12, the lecture portion. I realize there's a lot here. I get it. We're going to come back and we're going to work through some examples of all these 6 decisions that we have to make in this chapter. Okay? So the next couple videos are going to help you out with your study guide, and hopefully will reinforce what we talked about in the lecture portion. Okay, so please tune back in for those.